Hello and welcome. In this lecture video, we're going to be talking about dividends. Okay, so you can receive dividends, which are just distributions of assets to shareholders. And so in one of the other lecture videos, I talked about, for example, how I am a shareholder of Pepsi. I own a couple shares of stock in PepsiCo, and every quarter or so, I receive a check, a dividend check. And so what happens is Pepsi says, we had a great quarter. Everybody claps their hands, pats themselves on the back, and we say, okay, what we're going to do is we're going to give all of our shareholders 10 cents for every share of stock that they own. So if I have 2 shares of stock, I get a check for 20 cents, or it could be direct deposited in my account for 20 cents. Okay. They're typically pretty small because I don't have that many shares of stock. But that would be an example of a cash dividend. So we're distributing cash to our shareholders because we had a good year or a good quarter. Okay. Dividends don't have to be in cash. They could be in additional stock. And so that's something we'll also talk about. But why don't we go ahead in terms of our journal entries? We'll start off our discussion by talking about the journal entries, the accounting for cash dividends. Okay. So to pay a cash dividend, the corporation has to have a sufficient balance in retained earnings. They cannot have a debit balance in retained earnings. Okay, a debit balance, remember, retained earnings is an equity account. So to have a debit balance when the normal balance of retained earnings should be a credit, to have a debit balance is unusual. And how could you have a debit balance and retained earnings? That could be when the company has cumulative losses and pays more in dividends than they've had in total earnings from current and from prior years. So basically, they've had a lot of losses, they've debited retained earnings, and they've also paid out a lot of dividends in the past. And now they have a debit balance and retained earnings. They shouldn't be paying dividends. Okay? So when we talk about the journal entries for paying dividends for our cash dividends, we have a couple different dates that we need to consider: the date of declaration, the date of record, and then the date of payment. And we talk about the date of declaration. That is the date on which the directors vote to declare and pay a dividend. At that point, we've created a liability for a corporation. Okay, and we'll record a liability for the dividend on the date of declaration. We also have our date of record. This is a future date specified by the directors for finding all of our stockholders who should be receiving dividends. Okay, usually followed by a few weeks, by the date of declaration by a few weeks, and there's no journal entry. So we will do a journal entry on the date of declaration. We do not do one on the date of record, but then we will do a journal entry on the date of payment, and that's the date the corporation makes the payment. Okay. So let's look at this in terms of our example right over here. So we say on January 1st, a $1 per share cash dividend is declared on Dana Incorporated's 10,000 common shares of stock outstanding. The dividend will be paid on March 19th to stockholders on record on February 14th. So let's talk about these dates in terms of up here. The date of declaration, January 19th. Okay. The dividend will be paid on March 19th. That's the date of payment. To stockholders of record, the date of record is February 19th. Record the appropriate transactions. Well, I don't need to do a journal entry for the date of record, but I do need to do a journal entry for this date, the date of declaration, and the date of payment, which is going to be January 19th and March 19th. Okay? So on 1/19, what I'm going to do is I'll create a liability, okay? Record a liability for the dividend. Now, my journal entry on the date of declaration is I'm going to debit retained earnings. I'm going to debit retained earnings. How much will I debit retained earnings for? The total amount of dividends that I'm going to pay. What's the total amount of dividends I'm going to pay? The number of shares outstanding times the dividend per share. The number of shares outstanding times the dividend per share gives me how much dividends I'm going to pay. Now you should be thinking that, well, okay, he said the word pay, which means that eventually we're going to credit cash. Yes, we will down here on the date of payment. But on the date of declaration, this is just when we create that liability. So what do I debit on the date of declaration? We know we're going to credit a liability because we are setting up a liability, which means liabilities are increasing. So we know we're going to credit a liability. What do we debit? We debit retained earnings. Okay. Now, retained earnings, right, is an equity account. It's an equity account. So if I debit an equity account, that means it's decreasing. So basically, by debiting retained earnings, I'm decreasing my retained earnings. I'm decreasing my retained earnings. So I debit retained earnings. In this case, it's the number of shares outstanding times the 1. So in this case, it's $10,000 for $10,000. And then I will credit my liability of common dividends payable for my $10,000. And that's my journal entry right there. Okay. Now on 3/19, which is the date of payment, and I'm going to flip the page over. Let's look at that on 3/19. It's not 9. 3/19, right over here. I'm removing that liability, so I'm decreasing the liability. How do I do that? With the debit. So I debit common dividends payable for that $10,000, and then I credit cash for my $10,000. Okay? That's my journal entry on the date of payment. There is no journal entry on the date of record. No journal entry needed there. This is the date of declaration. That's down here. Okay? And then the date of payment is when I debited my common dividends payable and then credited cash to recognize that I paid the dividends. Okay? This is, I was saying earlier, deficits and then cash dividends. Corporation with the debit balance and retained earnings has a retaining earnings deficit, and most states prohibit a corporation with the deficit from paying the cash dividends. Again, how can we end up with a debit balance in retained earnings? Lots of losses over time. Okay, and then also paying a lot of dividends in prior years will cause a debit balance in retained earnings. So we just talked about the journal entry for cash dividends, but we can also issue additional stock. So we can have stock dividends. So what is a stock dividend? It's additional shares to our stockholders. Okay? And so what this does is it doesn't reduce our assets or equity, and it transfers some of our equity from retained earnings to our contributed capital. Why would we want, as a corporation, why would we want to do this? Why would we want to distribute additional shares of stock rather than cash to our shareholders? Well, that could be a way to keep the market price affordable. Well, how does that work? Well, think back to your economics classes. Right? If you've taken economics, what happens to the supply of shares when we issue additional shares? The supply of our shares goes up. Supply goes up, and then the price is going to fall. Okay, so that can help keep the stock price affordable. It can also provide evidence of the management's confidence that the company is going to do well. We think we're going to do so well, we're going to give you additional shares of stock. Okay. The other thing about issuing those cash dividends is that you have to have that cash on hand. Okay. So think about that with regard to our stock dividends. Now, in terms of our journal entries, our accounting, that's what I mean by accounting, our journal entries for stock dividends, it depends upon whether that stock dividend is classified as small or large. And a small stock dividend would be our distribution of 25% or less of our previously outstanding shares. And what we do in that situation is we capitalize retained earnings for the amount equal to the market value of the shares distributed. If it's more than 25%, that's a large stock dividend. So we will capitalize retained earnings for the minimum amount required by the state law, which is our par value or the stated value of our stock. So this probably doesn't make very much sense, right? We need to look at an example to really solidify your understanding here. So let's look at our example of our recording a small dividend, which would be 25% or less of the outstanding shares of stock, okay? So Simmons has 100,000 shares, 100,000 shares of $1 par value stock outstanding. Simmons declares a 2% stock dividend. Well, this is less than 25%, right? 25% or less, so this is a small stock dividend. Small stock dividend right over here, okay? When the stock was selling for $10 a share, the stock will be distributed to stockholders on January 20th. Let's prepare the journal entry on December 31. Now, December 31 is the date of declaration. This is the date of payment. Remember, the date of record, we don't have to do a journal entry. So we will do a journal entry on 12/31 and January 20th. Okay, so let's look at 12/31. So how do we do that? It says up here, recorded by capitalizing retained earnings for amount equal to the market value of the shares distributed. Well, what's the market value of the shares? It's $10. Okay, $10. That's the market value. This is the par value. And it says right over here, we capitalize retained earnings. Well, in terms of journal entries, in terms of debits and credits, what does that mean? It means we're going to debit, reduce retained earnings. We're going to reduce retained earnings and move it to paid-in capital and common stock. Okay, that's what we're going to do. We're going to move it out of retained earnings to common stock and paid-in capital. Okay, so equal to the market value. So I'm going to debit retained earnings equal to the market value. Well, it's 100,000 shares times our, look over here, 100,000 shares, and it's our $10 a share, but it's a 2% stock dividend. Okay, so we can take our 100,000 times our 0.02, which is equal to the number of new shares of stock, right? Times, right over here, our $10 per share, which is our market price. Okay, so I'm going to debit retained earnings. As I say up here, capitalize retained earnings equal to the market value of the shares distributed. What I just calculated right over here is the market value of those shares. 100,000 existing shares, 2% additional shares. That's our 2,000 shares times the 10, gives us $20,000 right over here. So I'm going to reduce retained earnings by 20,000. I'm going to capitalize retained earnings, debit retained earnings equal to an amount equal to the market value of those shares distributed. That's exactly what I did right here with the debit to retained earnings. Now, where do I move it to? I'm going to move it to my common stock distributable, because this is on the date of declaration. This is going to be for my par value, which is my $2,000. It's $20,000 here, the market value, $2,000 par value. How did I get that? My 100,000 shares times my 0.02, 2,000 new shares, times my $1 par value per share gives me my $2,000 right there to my common stock distributable. Okay, so then the difference goes to paid in capital. Okay, I'm just going to write paid in capital there because I'm running out of room. But remember, the full name is paid in capital and excess of par equal to the difference between the par and then the market, $18,000. This is the journal entry on the date of declaration. Let's look over here on January 20th, which is my date of payment. So now what I have to do is I'm going to debit my common stock distributable. So that temporary account that I set up on the date of declaration for my $2,000, and then I will move it to common stock for $2,000. Okay? Right over there. All right, so I'm going to end this lecture video now, and then I'm going to pick up on the next lecture video where we left off. Okay? Thanks so much.